This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Big flashing warning today. A new book from yours truly, authored by yours truly. That would be me, Michael Covel. The new book, Trend Following Mindset. Guess who it's all about? One of my favorite podcast guests, Tom Basso. This book has been in development, underway for 18 months, 2 years. These book things just take a long time. I'm not sure why that is. I guess things can go faster, but I must say, this is a very cool book. I'm very lucky to meet Tom. I'm very lucky for Tom to come on this show early and help establish this show. He's easily one of the top 3 favorite guests on this show. No doubt about that. So we both decided, let's create a book. Let's do something cool. And of course, I want to give something back. I want to let everyone know how interesting, how insightful, how wise Tom is. And this book, out right now, Kindle, hardcover, and audiobook, is my effort to show that great Tom wisdom. Now, here's a little side cool thing. This is one of the best looking books ever. No joke. It is just an absolutely cool looking book. Buy the audio format if you want, fine. Buy the Kindle if you want, fine. If you buy the hardcover of this book, I guarantee you, you will never, ever, ever do anything with it except make sure it's displayed. Now, of course, you're going to read it. The content's great. I'm not silly enough to say buy a book just because the cover looks awesome. I mean, do you really think, if you know anything about Tom, that the insight, the pearls of wisdom, the writing could be anything but great? Of course, that's a given. But as that bonus, the aesthetic, the appeal, the look and feel of this book is just awesome. Now, of course, I've got a great candidate to put on the back cover, and Tom has this fabulous picture that you may or may not have seen that's on the back cover. Just great. Cowboy hat on the front cover. I'm telling you, buy the hardcover book. People will pick it up in your house just to look at it because it's so damn cool looking. Then they'll start looking through the pages and they'll be like, oh, this is interesting. I didn't know this. What does this mean? That's insightful. That's cool. Next week, Tom and I will do a new episode to talk about the book. So that's coming. Stay tuned. But today, a blast from the past, and staying in that Tom Basso trend-following mindset, let me go to 2 trend-following traders, Larry Height, Alex Gracerman. Alex learned from Larry, and they've worked together for 20 or 30 years now. And this episode goes back to 2014, the one I'm about to replay. Now, you might be thinking to yourself, if you're not familiar with this show, why would I want to listen to an episode from 2014? Do you know why? Because whether it's this podcast or my books, I aim for timeless. I'm not producing topical bullshit that lasts only for that week's news cycle. That's not what I do. I've never done that. I never will do that. It's boring to me. I want timeless, just like Tom Basso and our new book, Trend Following Mindset. Timeless, timeless, timeless. So in the spirit of timeless, let's not delay. Let's jump right into a little Larry Height and Alex Gracerman. Oh, one more note. Go buy the new book, Trend Following Mindset. Without any further delay, let's jump into Larry and Alex. Today on the show, I have Larry Height and Alex Gracerman. Larry and Alex are both with ISAM. Larry, for those of you out there who recognize his name, was originally first featured in the Market Wizards book by Jack Schwager. He was also in my book, Trend Following, and appeared in my film. Larry's a good friend, a great interview. We have spoken many times over the years. Alex is chief scientist at ISAM, PhD in statistics, also a professor at Columbia University. Both Larry and Alex, decades of experience in the trend following space. Also, to note, Alex has a book coming out on the subject of trend following and managed futures later this summer. I hope you enjoy this episode. There are some critics out there and some people that don't perhaps understand trend following that like to declare it dead every time there's a drawdown. And what are they missing, Larry?
They're missing that it's an extremely effective risk management tool. But it's not a perfect tool. And, guys women who really don't know much always look for perfection. The only people who little girls, I have two daughters, now a granddaughter, when I'm my first grandson in about a month, they're into perfection. Well, perfection is, as Plato says, it's a concept. It's not true. You don't get perfection. So you deal with the world, you deal with it on a Bayesian probability. And that's what they don't get. Because it's like most books about gambling, and going always back to Dostoevsky and the Gambler, are about one guy trying to defeat the monolith. That's the drama. That's what people want to see. But in reality, the money isn't running the casino. And basically aiding risk transfer. And many, many, many years ago, before any of you were born, the futures trading at Penn and Wharton was in the department of insurance. And that's what we do. We're in the insurance business.
For that crisis alpha.
Yeah, crisis. Yeah, it's going to come. We don't know perfectly when it's going to come, but we take bets on it, and we get paid for holding it. We're in the risk transfer business. That's what markets do. Somebody owns something or wants to own. The people who want to own that risk take it on. The people who sell it are people who don't want to own it anymore or trim their books.
I'll give you an interesting stat. In the past century, equity markets have had 4 drawdowns of more than 30%. Which equity markets you look at, depends. But if you kind of look at a combination of equity markets, 4 drawdowns this century or this past century of over 30%. Number of such drawdowns for trend following at the same level of volatility, 0. Right? NASDAQ is right now in a 14, 15-year drawdown. So, it's part of our standing argument that it's just trend following is an asset class. It's not particularly better asset class or worse asset class. It's an asset class, and it has asset class type of characteristics, and sometimes it works and sometimes it doesn't. But if you look at the stats over 800 years, it's pretty darn good.
Alex, let me go there. That's where I was going to go with you, is the 800-year study. So your firm did an 800-year study. Why don't you explain to the audience what was the premise, what you found out?
Well, we looked at market data going back to, believe it or not, some data goes back to BC on markets like Bangkok rice, but a time period from which we have a reasonable number of markets, which is roughly 10 or more, goes back to 1222. So just about nearly 800 years of data. Now, obviously, the futures markets didn't exist before a certain date. Some of these markets, you can look at the data and sometimes you have to clean it up or it's not so reliable. But in the big picture, it gives us a feel for what went on. And we went back and applied fairly simple, traditional trend following systems. Cut your losses, let your profits run. Fair enough, we made certain assumptions that we could go long, we can go short. Whether we could have actually done that is a debate, but over 800 years, it gives us a reasonable picture. And we have statistics for 8 centuries of data, and we look at things like drawdowns and the length of drawdowns and the average drawdown and the longest drawdown and the recovery and all the sorts of things that people like to look at, but they typically do that with 5, 10, 15 years of track record. Now you have 800 years. It was so big that you couldn't even barely load it into Excel. Now I'll just give you a few stats, but just a few interesting stats, like the largest drawdown, the length of drawdown, and in comparison to equity markets, we have equity market data from the late 1600s, and we have fixed income data from around 1300. Venice used to issue bonds, so the Venetian bonds from 1300. So we can compare the performance and trend following by itself and also to equity markets for around 300 years and to fixed income markets for around 700 years. I mentioned one stat before about the fact that equity markets have actually had much bigger and sometimes much longer drawdowns. If you look at equities for the 400 years that we have, the stats are roughly what you would expect, kind of high single-digit annualized returns over these 300-some years in equities with low double-digit volatility and some very large drawdowns, 50%, 60%, and very long drawdowns. I'm talking about equities again. 10 years, 15 years. In this current case of the NASDAQ, it's a 15-year drawdown as we speak. If you look at trend following drawdowns, they're actually quite reasonable. There's a handful of drawdowns, but the average depth and the length are not particularly large. They're in line with equity market statistics. One thing I looked at was, assume you bought equities every month of the history. How many times would you be down 4 years later? I just picked that as a number. So how many times would you have invested in equities and 4 years from that point of investment still be down? And it turns out that's right around exactly 10% of the time. In trend following, if you do the same exercise, you assume you bought into trend following throughout the entire history, how many times would 4 years later would you still be down? It's about 9% of the time, so it's roughly similar. The point is that we have roughly similar asset class characteristics, roughly similar statistics, but we have zero correlation. So to equities, which means any sort of combination of trend following with equities or with bonds,
it's win-win.
Clearly improves the risk-adjusted returns of the investor, which is the argument we've been making, that people should consider this an asset class and allocate some percentage of their assets to this.
Let me get you to expand on the 800-year aspect, because I want people to understand why it's important, is that correct me if I'm wrong, but looking back at 800 years, what you're really looking at is measuring the buying and selling. You're really measuring human nature. And I'm assuming that you at your firm, Larry, you guys all believe that the 800-year study just confirms our understanding of human nature. And human beings like to create booms and busts and bubbles, and there are trends in markets. And I'm assuming that's a lot of what you found out in the data.
That's right. We actually even looked at tulip prices and what would have happened and some other kind of like chaotic events. And it turns out that trend following would have actually done well in those environments. I mean, partially it's human nature, but partially it's just fundamentals in markets. I mean, there have been, for example, in the last couple of years, there was not a lot of trends in ags. So we didn't do so well in the ag markets because kind of no major events happened. And then last month, there was a tremendous fundamental event in lean hogs, and the prices went through the roof, so to speak. I mean, it's the fundamental event is still unfolding, so I don't know what's going to happen, but literally as we speak. So, yeah, what we've done over 800 years is not just human nature, but to see that things happen. And when things happen, we just try to make money out of riding the waves. At the end of the day, there's a lot of devil details, but it's not complicated. We're extracting natural divergence in markets, which has lasted, dare I say, forever. But sometimes, in the last couple of years, when certain strategies, when they stop working, people think that there's some sort of fundamental causal event, like government has made a law that this strategy will never work, or, for example, stat-arb strategies, which used to work, don't work as well anymore because of decimalization, whereas before you used to have big spreads. So certain structural things just kind of kill or impact certain strategies. In our case, actually, the drawdowns, it's actually the stops. It's sometimes when the markets get whipsawed, the risk management actually costs you money because, market goes up and then it comes down and you get stopped out and you go short and goes back up. So, but that's the name of the game. We take small losses and we stay there to survive, as Larry said in Market Wizards, right? Don't lose. What was the phrase? You can't bet it. What was the chip phrase that exactly?
You can't win if you don't bet, but you got to have your chips.
Yeah, you can't bet if you lose all your chips. So if you look at the graph of equity markets for the last 3, 4, 5 years, people ask me, well, why haven't you made a lot of money from that trend? Because it's been, 100% move in the S&P in the last 4 or 5 years, or I'm talking just post 2008, or 150% move up, something like that. I mean, S&P hit a low of 666, and it's now at 3 times that. So why haven't we made a lot of money being long equities? Not because we're fundamental stock pickers, just because we ride the equity wave in the trend following system. And the answer is we have made a little money in equities, not just us, probably most trend followers, but not as much as you would expect, because along the way, equity markets have had a handful of corrections. And if you manage your risk, you get out of those points, because those are the points that might have continued, and we might have then generated the necessary crisis alpha to display the benefits of this asset class.
Yeah, that's a great point, because I think people get so fixated on what have you done for me lately, they lose sight of the fact of what is this unique strategy that you're applying. And maybe you could expand with this, either Larry or Alex, is if we look at the last 4 or 5 years, interest rates don't exist anymore. So there's no more interest income. You have equity markets at, all-time highs. I don't think anybody deep in their gut could think to themselves, oh, this will go on forever. And so if you kind of think to yourself that, and look, I'm not making a prediction, you guys aren't making a prediction, but we just all kind of know deep down that the Goldilocks will eventually go away. And if and when Goldilocks goes away, what other strategy beyond trend following will be there to benefit?
In our case, we have gone short equities something like 7 or 8 times in the last 5 years. Every single one of those trades has been a loss, right? Because we would go short when the market starts turning down, and then QE comes out or something comes out, and the market goes right back up. But like Larry said in previous conversations with you on writing, there's not 2 types of bets: good bets and bad bets, good bets and bad bets, right? There's 4: good bets that win, bad bets that win, that win, and good bets that lose, and bad bets that lose. In this case, the strategy made what it considered a good bet because there was an appearance of a pending reversal in the equity markets. It just didn't play out. In 2008, it obviously played out extremely well, in high double digits returns across the industry.
Alex, why don't you expand on, because I think what you're really talking about is the risk management. And, I've seen in your writings talking about this, where this isn't VAR risk measures, this is the actual money. I mean, you guys it's about ultimately cutting your losses, because as you've both said on this conversation so far, if you don't have any chips, you can't play, and no one knows what's going to happen. So you have to manage your risk.
It's like auto insurance, right? I mean, who wants to buy auto insurance? But you really don't want to take the risk of getting killed or, the suits and everything else. So basically you pay to have peace of mind. We use trend following and stops to get peace of mind. Because we don't want to lose those chips. Because that's how our business functions.
If you look at the size of those drawdowns, like I mentioned earlier, they look painful. Depending on any particular CTA or CTA industry, down a couple years in a row, or down this or down that. But actually, looking at the biggest scheme of things of drawdowns in other asset classes, it's small. I mean, we don't go down 70 or 80% like emerging market equities, for example, or like the Nikkei. I mean, I don't even know what's the length or the size of the Nikkei drawdown. Does anybody know? I mean, it's obviously huge, right? I mean, the NASDAQ drawdown was huge, and it might take 20 years to get out of it. I mean, so even though it looks bad, it's actually, relatively speaking, if somebody had a 10 or 20% allocation to this kind of strategy, and the equity markets ran up 100% on the rest of their allocation, and meanwhile they lost, the equivalent of a few percent on this, it's not the end of the world.
Look, if you go back and you look at marriage, right? Marriage has to be the major decision most people make. The last time I looked at this, and I've been married a long time, 50% of the marriages ended in divorce. That used to be the general rule. So you gotta believe that no one has perfect knowledge. And even if you have perfect knowledge, and Alex and I did an experiment years ago, where I posed the question to Peter Matthews, and I had Alex did the work, Peter Matthews and I had the argument. And I said, well, what if you did have perfect knowledge? Well, find that if you had perfect knowledge as to what would happen a year in advance, it didn't help you. It didn't help your risk management, because you could go down and lose 40 or 50%.
Yeah.
And this is not, so this is like paying that auto insurance. It's a cost. But it's a cost that's well worth it. And it has tremendous flexibility in it. You can choose what you're going to lose. It's very hard to do that in a lot of businesses. I'm looking at my back window, front faces Central Park, but there are all these buildings. Well, once somebody starts to put a spade in the ground to build any of these buildings, it's very costly to pull out. And if the buildings are not rented up fast, they become big drainers. So nothing in life is perfect. The way you get through life is you survive. And I just read a book called Extinction, because whole species die. Bad. They can be around for 1,000 years and die. So this is a very efficient way of managing the risk of financial debt. But it has a cost.
Depending upon how you allocate to the markets and what's your speed of trading, you can get quite different results. But then your portfolio benefits could be quite different. Let me give a real live example. Suppose we were running, everybody's read Michael Covel's many books, and people know what basic methods of trend following are, some kind of whether it's a moving average or looking at the price history. It's not really rocket science anymore to just look at whether the price has been going up or down. Well, suppose we were using a quite long trend following system. By long, I mean just long time period. 200, 300, 400-day moving average, just make up a number. It would have actually, if we looked at our data analysis, it would have actually captured the entire equity up move. Well, in 2009, it would have taken a bit of time to get on the long side once the S&P rebounded from 666, and somewhere along the way, depending on the system, perhaps at 766 or 866 or some S&P level like that, the system would have turned long, and now roughly 1,000 points higher, it would have still been long and made a lot of money. Okay? A somewhat faster system, even a 100-day moving average, or just, again, making up an example, would have been a bit whipsawed, because along the way, the S&P did not go in a straight line, and it would have gotten stopped out, and it may have even gotten short a few times, which inevitably would have probably been losing trades because the market move kept going up. But the ones with the longer time frame actually bring in more sort of the natural beta, and they take away from the crisis alpha benefits. So in other words, if somebody were to say, I'll put 100% of my money into trend following, I might suggest a longer time frame system, because they don't have otherwise any exposures to equities or bonds or commodities, and a longer time frame system may allow them to get exposure to the benefit from some of the really longer term trends and moves, if that makes any sense.
Yeah.
But if they have, let's say, a 50% allocation to equities to begin with, a pension fund or private investor or whoever, they don't need something which is then going to be highly correlated to equities. Yeah, we've used equities as an example of a market that's made a big move in the last 5 years. We could pick any other market. But, Mike, do you think that kind of helps thinking that kind of an example?
Absolutely. And I'd like to go back to something that you both brought up too, because you were comparing, as you define it, the asset class of trend following, the strategy of trend following. You were comparing it to things like the NASDAQ and the Nikkei. But the NASDAQ and the Nikkei are just individual markets that people can buy and hold. There's no thinking behind that. There's no risk management there. There's no strategy. It's just buy and hold. And I think that's what a lot of investors want to do. They want to take a strategy like your firm undertakes, and they want to compare the strategy to a buy and hold market. But it's two different beasts. I mean, it's two different things.
Yeah, but most investors have an allocation to that buy and hold because they've been, dare I say, either brainwashed or taught, depending upon which view you want to take, that they just need constant exposure to those things, right? And as those things go down, they just kind of pray that they go back up or hope that they go back up, and they just hold them, right? So to them, what we offer is the ultimate portfolio diversifier. I mean, we are like this monster in the corner. What's happening? One point I want to make, that what's happening in the trend following industry right now is because of some of the recent kind of lack of performance, a number of industry participants are trying to diversify away from trend following by doing other things. Could be carry strategies or long-only strategies or any number of things. In and of itself, okay, that may be a noble objective, but actually what we think that's doing is, we have a paper on this, and it's part of the book, one of the chapters, is they are diversifying the diversifier. Because basically anything you do to trend following that builds in some of that long beta or some of those carry type trading characteristics will just lower the crisis alpha and lower the portfolio benefit.
I think might be interesting for both of you to offer an opinion about this is not necessarily about trend following, but maybe offer an opinion, look, and you're not trying to be fundamental experts here, but we can all look at what's going on in society. And Larry, you've seen several booms and busts in assorted markets in your career. And I think, getting back to the beginning of our conversation, and maybe as we wind down, what's changed? What's changed about human nature, Larry?
Nothing's changed about human nature, right? If a really good-looking girl walks by, guys' heads will turn. In a gender-neutral environment, girls will say, will look at the guys. Same way that the guys look at the girls. Nothing has changed. The context has changed. The speed has changed. But nothing changed. You get something, you buy something, and if it starts to go down, depending on how you get paid off by it, if you buy something with a good yield, so you'll tend to want to keep it longer, right? Because it's giving you something. So I don't think anything's changed. Speed has changed. Now we're in a no interest rate environment. When I understood that about a year ago, I went out and borrowed a lot of money. I bought a portfolio of interest-bearing stocks that were basically giving me a cumulative return much higher than I was paying for the money. So I think it's understanding the reality of what was your goal. Your goal is to basically always defend your purchasing power. You don't really care how much money you make, because if the value of the money is going down, that doesn't help you. Germany after the First World War. So you invest, if you're a rational person, for purchasing power, to accumulate it. And futures are kind of neat in that they allow you to do it economically and quickly. So when I had a car, I had insurance. That's in case there was an accident. Well, it cost me money every year, but I didn't mind paying that money because it cost me a lot more. So for a small amount of money, I hedged myself. I hedged that risk.
Yeah, I think that the hedging of the risk, the transferring of the risk, I think if there's anything that the audience can take from listening to both of you today is the idea to think about this risk transference process and, let the profits take care of themselves. But the reason that drawdowns happen is that nobody knows if those markets, when they turn and go the other direction, no one knows how far they're going to go. And you've got to protect your purchasing power. You both have been very clear about it.
Yeah, Mike, I just want to add that the system is not just, leave it alone. What I'm talking about is leaving alone the allocation to a pure trend following. But again, it depends who you are as an investor. If you say it's the only investment I'll have, it's the only investment I will make, I just want a CTA and I'll put all my money in that CTA, whoever says that, all the money. Well, that's a slightly different utility function, because then it may be okay to include, like I mentioned earlier, longer-term strategies or some carry strategies, or do one of these kind of like multi-strategy CTAs. But if you're an investor that naturally has exposure to, call it standard things, bonds, equities, because it's just in the portfolios or the institution, it's already in there. Okay, then you need this as a portfolio diversifier. But then we, as a manager, and I assume others, we don't just sit on the same strategy. We do this, what I mentioned earlier, across the board, mentality. We have many more markets now that we can try to capture trends in, many more risk transfers that are going all over the place. There is this kind of futurization going on, bring a lot of markets on the exchanges. I'll give you an example of a market we made fair bit of money in recent history, emissions. I know Larry probably wouldn't even know how to spell the word emissions, although I do remember the car. I remember the used car you gave me, Larry. That was putting out a lot of emissions.
Larry, are you going to take that dig, Larry? Come on now.
You gave me that Mercedes that was like putting out a lot. But anyway, emissions, 10, 15 years ago, what is that? Now it's actually a fairly liquid futures market. We don't get involved in any sort of over-the-counter crazy stuff. And we made a fair bit of money, as I recall, actually being short. We have some German power and some other markets. So we are actually making a massive effort not to win some kind of a medal for trading the most amount of markets, because you could just stick in 1,000 markets and trade one contract, but to actually have meaningful allocations to markets. So we're not just, the whole thing is not just, we have had a whole discussion about the equities, but the whole thing is not dependent on whether we catch the next equities turn or not. I mean, at the end of the day, it's still only one market. I mean, it's still small compared to all the other markets. So we actually make it a mission of ours to diversify as much as possible everywhere and to generate P&L from divergence, as we call it, in as many places as possible. And that's how we kind of go on offense during these kind of environments. Now, if there's no trends in all the places, then we will just cut our losses and kind of go into a hibernation mode. The natural thing, great thing about this strategy is almost risk manages itself. If we have less signals and less trends, we have less risk, and it just kind of hibernates until something happens and there's a crisis in hogs or somewhere, and it just comes back and jumps right back in. It's got that natural mode. It never adds to losing trades. That's what gives it that survival capability. But the more markets we can do this on, the more we can take advantage of lower transaction costs, which are much lower now than 20 years ago. The more things we can trade, and the more diversified we can make it. And
hey, Alex, let me pick on some of the comparison markets for a second. So you've both been very honest about the perceived negatives by some people that are learned and some people that don't understand trend following, and we've talked about those at length today. But I think it's worth mentioning as a comparison. We've seen multiple booms and busts in the S&P in the last 15 to 20 years, and I think it would really be wise for the audience, maybe the audience out there that's not familiar with this, is to say to themselves, if you can see the S&P drop 50% in 2008, if you can see it drop 50% in 2000 to 2002, why can't you imagine it happening again? I mean, look at the Nikkei. Where's the Nikkei at? 15 grand? I mean, where's the all-time high? 1989? I think people really need to think about, while you guys have both very honest and you've laid out the negatives, I think there's a huge positive here too, which is the comparisons are not going to always go up. At least the evidence says to us that the comparison markets that everyone loves to talk about, the buy and holds of the major equity indices, in particular America, don't always go straight up. They can have major down periods and major drawdowns that last decades.
Yeah, and if you actually look at the data past 2008, here's an interesting fact. So just after 2008, okay, suppose you had an investment which was 50% equities and 50% trend following. Obviously, your 50% equities, I mean long only, would have made 100% or whatever the equity market's gone up. The 50% in trend following in the last 5 years, again, depending on the manager you selected, but it's roughly flat, right? Because again, we as an industry don't have 80% drawdown. So roughly post 2008, if you just take 2009, 2010, 11, 12, 13, it's roughly flat. Well, hey, in the scheme of things, if you have an asset which people say is dead and it's been like roughly flat for 4 or 5 years, I mean, I'll take that all day long.
Compared to the NASDAQ, for example.
If it's the other way around, then you get like 80% drawdowns if you go the other way around. So if you look at 2008 and you had a 50-50 mix, you would have made a lot of money in trend following, but you lost it all in. So you have this, what Larry has called for many years, asymmetrical leverage. On the downside, we could have losses or we could tread water for a few years and it just looks like nothing's going on, but our upside could be much, much bigger. So we have this, for the statisticians in the audience, a positive skew, right? And, there's very, very, very few strategies out there anywhere, except for trend following, I'm not aware of any, that you have a positive skew. And that's what gives it the benefit. So when it does poorly, I mean, it's still okay. I remember 1994, trend following was declared dead. Remember, Larry? And there was like 5 CTAs. So it certainly wasn't like some kind of a dominance of the industry. There was like 5 or 10 CTAs, and it was dead because it was in a drawdown. I mean, we've heard this 6 or 7 times.
I had the privilege of getting to know how Janine, the guy at ITT, and he said to me one day, he said, Larry, business is not like going to the movies. Well, you buy a ticket, you go to the movies, and you wait, you see how it turns out. So now in business, you have to know where you want to go. And the sole biggest thing that any investor, I don't care if you're running a sovereign wealth fund or you're a guy with a small pension fund, you have to protect that buying power. That's it. You must do that. And that's what futures in a mixed portfolio does.
By the way, we've obviously we've looked at in 800 years what would happen if you bought these various investments, asset classes during drawdowns. Right, so we've obviously did that kind of work. If you buy equities during drawdowns, obviously if you knew that your largest drawdown was 80% and you waited till the equities go down 80% and you bought it then obviously you would have made money. But there's no way in hindsight you would know that's the largest drawdown. If you started buying when it was down 20 or something like that, you end up with a horrible result because you start buying when it's down 20 or 25 or whatever you might consider a reasonable size drawdown, and it goes down to 35 and 45 and 55 and in 80, and you'd be like up your eyeballs in Nikkei right now. You get stopped out by the brokers because you're running out of margin. I mean, so you would just, because some of the equity drawdowns just run. If you bought into trend following at reasonable levels of drawdowns, you would have done very well. If you did it 2 years ago, you wouldn't have recovered yet because it was still in the drawdown. But historically, because trend following has this kind of self risk management mechanism, when it doesn't do well, it just kind of like hibernates itself. We have this in the books, these statistics, but you do very well investing in trend following during kind of like drawdown periods, whereas you do extremely poorly doing that in equities and bonds, for example.
Well, Alex and I have a friend, a PhD from Princeton in, I don't know, physics or whatever. Really smart guy. And he got into stat arb. Stat arb is basically, you have his average, and you go down a couple of standard deviations, you buy more. As it goes down, it's an even better bet. Well, he basically is out of business. Because buying into that hole is not self-adjusting. You have to, what we have in trend following is we're actually getting rid of the losers and buying what we hope will be the next winners. And the proof that they're winning is that they're going up. Or the strategy is making more money. We don't care if it's long or short. But the point is, we don't stay in losing propositions. And if you look at nature, that's how nature works. You book sixth extinction. And you can see that whole species die out because the environment changes. Well, this is a flexible program we have. We can go wherever it's good. Doesn't matter. Because our task is to keep our buying power and our clients' buying power. Keep and increase.
I think that's probably a perfect place for us to end today. I think you guys have touched on a tremendous amount of topics. I think the audience is going to enjoy the perspective. And I think the buying power perspective is just terribly important. And if you're going to make comparisons across different asset classes, to try as an investor to be honest about what those comparisons are. And trend following has that built-in risk management strategy. There's not a risk management strategy going long the NASDAQ. You're just long.
Right. And, the marginal line was a very good example of what happens if you have one single strategy. It doesn't adjust. So they built the marginal line, and Germans just went around it. We're always, we're always adjusting to the environment. One of the great books I ever read was The Origin of the Species. And he has in the beginning, look, it's not the strongest and it's not the smartest. It's the most adaptable to the environment. That's what he means. Fitness for the environment. And trend following fits to the environment. It doesn't tell the environment what should be. It adjusts to what is.
And I think, Larry, you're known for the timeless wisdom. And I think you recanting that's the timeless wisdom. That's the takeaway, that people should just be that ability to adapt and survive. Adapt to survive.
Yeah.
That's the critical takeaway.
Yeah. So I thank you very much. But I mean, that's really what it comes down to. I try and get things done really simple.
Yeah.
And that's why I like trend following. Because it adjusts automatically to what's happening. And we use a Bayesian statistical. I didn't even know about Bayesian statistics. And it's funny because I grew up in the area of baseball, but they had that's what baseball averages are. They keep adding to the averages. They keep adjusting. Okay, well, Mike, thank you very much for joining us.
Absolutely.
And the next time you come to New York, let us know. We'd like to buy you dinner, or if you're going to be, we cross paths in London or China or whatever.
Singapore, for sure.
I look forward to seeing you.
Yeah, absolutely. Larry, I miss you. I always miss our conversations. We've had some great conversations over the years.
Yes.
Hopefully we'll cross paths. And Larry, if you can make it out to Singapore before I make it to New York, we'll do it.
Yeah, no, definitely.
Okay. Bye-bye. I love interviewing Larry. Just a really interesting guy. And as a little extra, a few minutes of our conversation, not about trend following.
What part of the world are you now, Mike?
I'm in Saigon today, Vietnam.
All right.
How do you like Saigon?
Larry, I'm a simple man, just like you. I judge places by the women, and it's good.
Yeah. Okay. Yes.
I shouldn't make it more complicated than that, should I?
No. Oh, because there was a time you could have got a free trip to Saigon.
One way.
Well, you didn't know it was going to be one way, but he could have been stopped out.
Yes, this is true.
Let me give you. So for you, what time is it, Mike?
It's 9 o'clock at night.
At night. Okay.
Yeah.
All right. By the way, when are you coming back?
I came back for a month and a half in December and early January. Then I came back here. So I was pretty much in Asia all last year, and then I came back here late January.
And you stay there for another 6 months, a year, week?
Larry, the trend is up, so I don't know. Should I get off? I don't know. I'm here for probably the year, but I'd like to go to Tokyo or Singapore, so I could end up there the second half of the year. So I'm not sure.
Okay. All right. And what is the attraction of Asia on a business-wise? I can understand the women.
Well, Larry, last year, we haven't really spoke. So last year I went on this speaking tour, and it turned out to be, I probably gave 45 presentations to hedge funds, mutual funds, Singapore Sovereign Wealth Fund, Malaysian Sovereign Wealth Fund, 5 of the top 10 largest mutual funds in mainland China. I was in Beijing, Shanghai, Guangzhou, Shenzhen, Kuala Lumpur, Singapore, Ho Chi Minh City. I spoke somewhere else. Where did I forget? Tokyo. And so I was all over. And it was just, for me, it was just nice to kind of dig in and see what the lay of the landscape is. I don't necessarily have the business part figured out over here. My business is not Asia. My business is everywhere. So, but I like the energy that I feel. It reminds me maybe of where we've been in America at certain points in time.
Okay.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.